Welcome to MentorNexGen. Learn from people who have been there, done that, and succeeded. Get mentored, build experience, and get hired. Today, we're talking about multifamily investment sales, where the deal market is in 2026, how AI is changing the analyst job, and where the human edge still holds. Today, my guest is Doug Banerjee, the Senior Managing Director at Greysteel, and one of the most active multifamily investment sales brokers in Texas. Doug, really appreciate you to making the time today. I want to start with how you actually got here because your path has been fascinating. You've been really successful in this industry. So could you briefly walk me through your background?
Yeah, no problem. Definitely did not take the most traditional path to get into commercial real estate brokerage, but I grew up always enthralled with math and science. And so I thought I was going to follow my father's footsteps and get into engineering. So I went to Virginia Tech, got my engineering degree, which for any engineer out there, um, you're basically a math minor, to become an engineer. So math's always been kind of one of my strong suits and passions. And I got the degree at Virginia Tech, but ultimately decided not to become an engineer and went into consulting in my 20s. Worked for Accenture and Deloitte back to back, doing some IT consulting, got to travel the world. And the last 3 years of that travel is what brought me to Texas. But during that time, I found my passion in commercial real estate, investing with a friend. And we have a student housing portfolio up in West Virginia. And I decided that that's what I wanted to do full time. So in 2011, I decided to get off the road. I turned in my notice to Deloitte and packed my car in Virginia and moved down to DFW and got into commercial real estate brokerage. So, like I said, not a traditional path, but the math has always kind of seemingly come naturally to me. And here we are almost 15 years later.
Wow, no, that's amazing background. And like speaking more from the engineering lens, I want to put it into your home market because the Dallas-Fort Worth area right now, I mean, the data is showing two different stories at the same time. It's a fascinating market. On one side, basically, it's led the country in apartment investment volume, and on the other hand, the supply is still heavy. Like vacancy is elevated, and rents under pressure. So, from your seat in Dallas-Fort Worth, what explains that disconnect, do you think? Why is capital still so active when the fundamentals say that market still needs time to digest new supply?
Yeah, I mean, look, that's kind of been the challenge with many markets, especially in the Sun Belt, but DFW has led the charge as far as number of units being delivered each of the last 2 years in 2024 and 2025, with roughly 40,000 units across the Metroplex each year being delivered and absorption being in the low 30s. So both are, I think, all-time high watermarks, meaning we've delivered the most supply in 2 consecutive years back to back, but also absorb the most. But when you deliver 40,000 and you absorb 30,000 for just good round numbers, that still leaves a gap of 10,000 units that need to get absorbed. And so that's why the data is showing and we're feeling it. Rent growth hasn't really kicked back in anywhere. And I think it'll probably take the rest of 2026 to absorb the deficit that we've had the last 2 years because supply has significantly or is significantly dropping off in 2026. Data or reports are showing we should deliver somewhere in the low to mid 20,000 range, so 22 to 25,000 units, depending on how many projects deliver on schedule. And so that's good, but we need to make sure that absorption and demand, keeps pace. So assuming it does, I think 2027 we'll start to see some rent growth and after the concessions burn off. So it's kind of a two-phase thing. We got to absorb everything, and depending on the market, we're seeing anywhere from 6 to 12 weeks of free rent, depending on how many projects are leasing up. And then obviously that needs to burn off, and then we can start seeing some real rent growth. And so I do believe next year we'll see it in a lot of submarkets, not the entire Metroplex, but certainly in 2028 we should start seeing significant rent growth in my mind.
What are three indicators that have to line up for you to personally like pull the trigger? How are those and how those indicators differ from the one you would build for an institutional client?
Uh, Institutional clients have a different mandate, right? Because their capital is going to be a lot cheaper than Doug Banerjee's capital. I need to kind of make my money go further. They're just looking to protect and kind of hit some certain thresholds, for their investors, whether it be for a
Yeah.
pension fund or what have you. So for me, I'm typically, I want to see if I can find a way to 2x or more my money in 5 years, which you so equity multiple being 2x. So I'm looking at deals that typically have some more value add component, and I'm very, I would say, basis focused when I'm looking at an investment. I know what deals are trading for today. I know what deals traded for in the past, and one thing that normally comes true over time is real estate always it goes through cycles, but if you hold it long enough, it's going to come back and be worth as much as what it was, at the peak of last cycle, and it's going to go beyond that. The question is, how long is that going to take? Is that in the next 3 years? I don't know, right? That it's probably not going to be the case, but maybe 5 or 7 years from now, we're going to be back at or above kind of what the peak point was in Q4 2021 or Q1 2022. So I'm looking at deals, from a basis standpoint, not only going in, but post rehab, right? What is the cost basis going to be? What is the yield on costs? I kind of cap rate going in is important for me, but I also, if I'm investing with an experienced operator, I want to kind of look and see what they're predicting. And of course, I'm doing my own underwriting. I want to see what the yield on cost is. And that just means stabilized NOI, typically in year 2 or year 3, depending on how big the project is, divided by the overall cost, right? So acquisition cost, CapEx, closing, etc. I want to see what that looks like and what the spread is to where I think cap rates are today for a stabilized deal.
Yeah, no, that definitely makes sense. I think the contrast is useful. Like personal capital can absorb time, but with institutional capital, it has to print like to a window, and that's I guess the difference between buying basis and buying yield. But that brings me actually to my next question. Earlier this year, public brokerage firms sold off sharply because um, investors started worrying that AI could disrupt high fees and relationship driven brokerage models. So, from inside the industry, how real is that fear? Do you think AI could actually threaten the brokerage model, or does it change how the
I
best
think
brokers operate?
I definitely think it changes, right? But I think the best brokers, and I try to keep myself, in that group, are always looking for ways to improve their business, right? So I think it'd just be being naive if we didn't think that AI was going to impact our business in any way. Might it impact our fees and things like that? But a younger guy on my team had a pretty novel thought in saying, "Hey, if AI does what everyone thinks it's going to do, hopefully it speeds up transactions, right? So even if you're making less on a per deal basis, if you can close more deals because lending is more efficient, raising equity is more efficient, and deals can get closed faster,
Mhm.
why does it take 5 to 6 months, for a commercial property to sell? It's because of all the lead time needed to raise the equity and to close the loan. Those are the things that typically take most of the time. The due diligence on most properties, depending on the size,
Yeah,
physical due diligence and lease audit, et cetera, especially with AI, should be able to get done relatively quick. So if
yeah,
those other things can get cut in half and the timeline 5 to 6 months gets cut to 2 or 3 months for a
right.
closing, so be it, right? Maybe the
Yeah.
fees do go down, but we can close more deals and just be more efficient all around and should still be able to, make good money is how I kind of look at it. So I'm looking at the tools to figure out how can I be more efficient with my business and help my clients better.
No, makes sense. And pull it down from like public markets to the actual desk and the tools that you use every day. A good example would be you use like RedIQ for multifamily underwriting, right?
Sure.
And I think AI is clearly making the market rental review and data cleanup and the scenario analysis much faster, right? So, um, I'm guessing that, AI could streamline a huge portion of the analyst underwriting work. So do you think the analyst job altogether is simply becoming more efficient, or do you think the job description of the analyst itself is going to be rewritten?
I think it's going to be rewritten a bit because, if I look back 12 months ago and even
Yeah.
today, 80 to 90% of what our analysts are doing on our team are financial modeling. But
Mhm.
as these AI tools become more and more robust and more reliable, and we're beta testing a lot of different things, Claude and some
Yeah.
other proprietary tools that clients have built. They're having us beta test and run
Yeah.
different deals through them to just kind of compare and contrast,
100%.
what our outcome is, through
Yeah.
RedIQ and the model that we've built through a somewhat manual process compared to a more automated process through AI. And they're getting better. I mean, in 6 months, like I won't be surprised if we can't, speed things up, hopefully 2x. So we did
Seems.
350 BOVs as a team last year, or broker opinion of values. And that's seven a week. It's a lot of underwritings to do. So, I am looking for the tools to kind of just be more efficient. And as far as
Yeah.
the analyst goes, they're the first pass at it. So if they can do more of those more efficiently and use AI tools to help out the team with other things, then I think that just makes us better all around.
Yeah. What are the best tools that you've used so far? In
Uh, I think Claude is probably the best one to kind of plug
Yeah.
into Excel and create some um, new formulas and things like that to review
Yeah.
the data.
Mhm. Of
And then we've got another one that the client's building out. I can't really share any details. I don't think at this point, but
course.
they've,
Yeah.
they've coded some things using Python and
Mhm.
they're using other AI tools to
Yeah.
kind of bring everything together to
Yeah.
more or less spit out an investment memo with a lot of different information built into their tool.
No, I mean, I'm guessing that would make it more competitive for analysts, to defend every assumption in the model, right? So I think that creates a higher bar. And actually, that leads me directly to something I have a personal stake in. So you've said that you're looking for AI fluency, analytical ability, people skills, and proactivity, when hiring analysts. Let's say a recent graduate were sitting across from you tomorrow wanting to break into commercial real estate. Which of those traits do you think like matter most right now? And what are some things that would disqualify someone?
Yeah, I mean, it's a good question, right? And a lot of times for guys or gals, you coming straight out of school,
Yeah,
um, some of it, I hate to say it, kind of I have to go with my gut, having interviewed hundreds of people over the years and probably trained or hired and trained more than over the last 10 years, probably, 20 to 30 analysts. Um, what I'm looking for typically is real passion for the industry because I'm not going to know exactly a lot of people may or may if they're not good at interviewing, well, then they're not good at interviewing, right? So as
yeah,
long as you've practiced and interview well and say the right things, that's going to be kind of number one. But number two, it's just like really showing a passion for the industry because then it doesn't feel like work. The analyst role is not going to be typically the end all be all for most people. It's going to be a stepping stone to get to the next level, whether that means become an analyst, then become a broker, or go into industry like many of our analysts have and go into asset management, acquisitions, or development. Because that's another path. But coming here, you get a lot of reps, you get a lot of exposure, or with other brokerage shops. And so I think that's still important to kind of build
hmm
that foundation, that analytical foundation that's going to set you up for success down the road, no matter what path. Or you could go the principal route, right? You could be an analyst and maybe you've got access to capital or are
hmm
good at raising money and can go and buy deals. But if you've analyzed hundreds or thousands of properties, right, then that's
yeah.
that's obviously going to be helpful when you're going out to pitch.
Yeah, no, you mentioned the hiring for the long horizon. Like, I want to ask the same question on the asset side, because I think student housing is one of the places where you personally bet on a long horizon for over a decade, right? So,
Yeah.
But with the demographic curve like flat to negative for 2 decades, what's the actual like underwriting case for new student housing by in 2026, like versus maybe rolling capital into Sunbelt multifamily or built to rent?
Yeah, I think as far as student housing goes, you have to get pretty
Mhm.
granular. If you talk Division 1 compared to Division 2 or Division 3, obviously there's more risk, right? The smaller the school is, and if it doesn't have athletic program and things like that. But I mean, it's a valid point. Like, so even if we stick with Division 1, then you got to look by conference, right? So the SEC schools,
Yeah,
for the most part, I think most of those still have, student population growth,
yeah,
whereas some of the other larger conferences may not. So I think you just got to kind of look at all those statistics, just like you would investing into a new market, right? Every school is a different market. Um, where I have personal investments at West Virginia University, it has over the last 10 years had negative student population growth,
yeah,
but they just hired a new president, I believe, last year, and I think it's starting to rebound and hopefully going to start going back up into the positive direction. But we were able to buy once again, going back to how I look to purchase things at a good basis, at a good cap rate, where we had
yeah,
positive cash flow day one and went in and operated
yeah,
better than the last guy. And so we sit in those deals pretty comfortably. And if student population does grow again and gets back up to the 25,000 plus range where it was 10 years ago when we were buying most of our deals, um, our properties are going to be even healthier.
yeah. No, that makes sense. I guess the consolidation towards like top schools and is what makes the underwriting still work. And the cap rate spread, I think that pays you to take the risk.
Sure.
So yeah. Now I want to connect two things that feel almost opposite, but probably aren't. On the one hand, you've got this relationship driven outreach, like the May developer lunch on mail merge. And on the other hand, big firms are going hard on AI, mostly brokerage firms like most brokerage leaders are saying agents are already using it. Like JLO has JLO GPT across a huge base, and CBRE is even claiming that AI can expand bidder pools by finding more matches. So my question is like, where do you draw the line? And in your view, does AI mainly win on the data or underwriting or buyer identification, um, while the relationship still win the close? Or do you think like brokers will eventually have to integrate their whole relationship network into AI tools to stay competitive?
I think the human component is the one where I feel is the safest, right? The
Mhm.
relationships and just kind of look at the end of the day, we're selling multi-million dollar assets for individuals, partnerships, or institutions. And to just rely solely on AI, something that's essentially a robot, right? To make those
Yeah,
decisions and not have a human kind of advisor in the middle of it, I think it's still going to take a while. So once again, I kind of see AI tools being leveraged, right? Which we're doing, and just trying to make some of the other things more efficient. So
yeah,
underwriting and packages and buyer identification, et cetera,
mhm.
take less time, but we're still going to have the face-to-face interaction and
To
meetings,
close the deals,
in
right? Yeah,
in tours and negotiations.
yeah,
So if I can be more outward facing because I'm spending less time, with the analysts or behind my spreadsheets, then I think it's just gonna, make my value that I can bring to the client that much better. And I just do think in sales and just the service industry, right? That human interaction is still going to hold a crucial piece in
yeah,
in our business for quite some time.
yeah. No, definitely. Like I think AI helps you decide who to call, but doesn't really like close the deal. So you have to. So yeah, no, definitely, that's gonna be important. So you said like three things in commercial state will not change, like relationship, deals, and equity. So for let's say a young finance student who wants to buy their first apartment building one day, what is the one principle they should bet on for the next 10 to 20 years, in your opinion?
I still think, even though we're talking about AI and all that, I still think really truly understanding what's behind the model, right? And
Yeah,
getting those manual reps in and
yeah,
becoming an expert. So what is it? It's like 10,000 hours spent on something is
mhm,
where you become an expert. So um, that doesn't mean you necessarily need to be an analyst for 5 years or 4 years if you're working
yes,
2,500 hours a year. But getting those analytical skills down and then having reviewed a number of deals
definitely. Yeah,
to to know what a good investment is, right? And
mhm,
where the risks are. Because there's no perfect investment. There's always risks. And just, being able to kind of analyze the data and track things. And come, what I've noticed is timing, right, on the investment, and then also who you're investing with on the
yeah,
operator side of things. What's their track record? How Even if they come up with a great pitch deck, it doesn't mean they're necessarily going to go and execute the deal to perfection or close to it. So somebody who who's been there, done it before, that you can kind of invest with or back, I think is a smart route to go.
mhm,
You can always kind of learn from other people and some of the things that they do well and maybe some of the mistakes that they make so that hopefully you don't make those same mistakes yourself. So if in, 8 to 10 years or whenever the time comes,
yeah,
you're ready and prepared for that because there is no perfect investment, but I do think you can minimize the risk with
mhm,
the knowledge that you can build over that period of time and especially utilizing the tools that are available today and are only going to get better.
yeah, definitely. No, I'm probably repeating this question again, but what do you think, in your opinion, what are the most important tools that one should focus on right now? Um, including Argus, actually. Do you think there's still value in getting um, proficient with Argus in terms of getting the certification for students or gaining some experience?
Yeah, if you want to go on the commercial side, not residential, Argus is
Okay.
still, the go-to tool.
Mhm,
I'm not Argus certified. I've not used the tool. I've
mhm,
been just focused on residential for the last 15 years. But certainly if you're going to go the commercial side, I think learning the uh the main tools and what AI tools are out there that can kind of leverage those and just kind of make
yeah,
things that much more efficient. Because if you have a retail building or an office building and you're analyzing dozens of leases, it can get
yeah,
very granular and detailed. So I think knowing how to use those tools is important. Um, yeah, and there's different courses out there
sure.
or
Yeah,
certifications. CRE Analyst is one
yeah,
that, a couple guys here based in Dallas, started up years ago
yeah,
and I always recommend, for people looking to get analytical skills. And it's not just for people like straight out of school, right?
yeah,
There are people that are managing director level and above that maybe haven't been in sales or investments. Maybe they're, in tenant rep or office rep where there's no real underwriting or kind of analysis as far as investments go,
yeah,
that do really well in their industries. They're going to CRE analysts or other things and getting certifications and learning how to analyze deals so that when they're making investments, they feel like they've educated themselves enough to know that they're making an educated investment.
for sure. No, Doug, this has been really generous of you. Appreciate the time and sharing your insights. It's been amazing.
Appreciate your time. Happy to do so.